this year we're seeing much more kind of disruption than I think many of the retailers had expected, and certainly in some ways than the consumers had. I think as we're starting to move into kind of Gen Z having greater spending power, that this is going to continue, and especially with this generation being stores first, it's really interesting to hear what you've got today. So I'll hand it over to you. Thanks so much, and we're really excited.
Yeah, no, I think it's a good way to frame it there. I think you're exactly right that 2025 normally takes a little bit more time for kind of the disruption to kick in, but it's been right there right from the beginning here, and a lot of interesting trends, not just from a macro perspective. I think a lot of people just assume that's what we're talking about here, but we're also seeing from a behavioral standpoint too. Some of the trends that we saw bleed through in the holiday season are really continuing into 2025. So we'll certainly talk about a lot of that too. These are always fun discussions. It's always interesting to see where the conversation goes. So anyways, with just kind of a quick agenda, what we're going to talk about quickly. First, we'll kind of go through those early trends that we're seeing in 25. We'll go through some of the things that seem to be sticking from the holiday period, and then obviously we'll go into some predictions for 2025 because who doesn't love predictions? In terms of just a brief introduction, for those who aren't familiar with Placer AI, we're a location analytics company powered by mobile data. In simpler terms, that means we can come up with foot traffic estimates for any physical place in the United States, really anything that you can draw a shape around on a map. So whether it be a retail store, shopping mall, shopping district, downtown area, really anywhere you can draw a shape around on a map, we can get data for. If it's individual stores, we can then roll up to the chain and then roll up to the category level. We'll be looking at a lot of that at the chain and category level today. Well, how does it work for Placer? Well, we partner with several dozen mobile app companies, and through those mobile app partnerships, we get data, 24/7 location data, about 25 million devices. That represents about 8% of the device population at this point. And from that population, we can then extrapolate and come up with full estimates for any place in the United States. So that's kind of the quick thing. But we're much more than just foot traffic now. And this slide here, what we're showing is some of the other use cases. And I think what's really interesting is that some of the things that we are able to do from partnering with other third-party data sets, we can then bring in things like demographic and psychographic data. It's important we don't bring any personal information into our panel. All that is stripped away before we receive the device information. But we do partner with other groups that have information about zip codes that those consumers may be coming from that can get us things like household income and demographic and ethnicity. Because right now, as you said, we are seeing a lot of changes in behavior, and it's important to understand what's driving that too. So I like to think of Placer data as kind of the what, how many people go to a store, how long they stay there, where else they shop, and it's these other data sets are kind of the why and the how, and kind of give you some of the explanation behind it. So if you're interested, please check us out at Placer AI. Be happy to walk you through a demo, answer any questions that you might have, even walk you through some of the use cases that you're trying to solve for.
And RJ, I think one of the things that's so interesting about the data, but also about your background is, the focus on restaurants as well. So, we've heard from a lot of retailers, that especially in enclosed malls, the restaurants are having a bigger impact in terms of traffic draw than they have in the past.
Yep.
And also as, right, this kind of return to the experience economy, I think you've got a really good kind of approach to thinking about that and also helping retailers think through that.
Exactly. Well, that's it's interesting too, and that's one of the things I love too is be able to look at that balance of power between food at home, food away from home, how the ripple effect may be impacting other categories. You're exactly right. We are seeing that restaurants, particularly kind of more experience focused restaurants, are becoming more of a draw to a lot of malls. A lot of malls are looking to expand on that, and it's interesting to kind of see the ripple effect and kind of see the derivative of all these trends. And that's I think the beauty of the Placer platform is that we can start to look into those things. So. Anyways, that's a perfect segue into kind of just starting to look at 2025. And I thought we'd start with just kind of, staples retail here. And so on this next chart, what I'm showing is year over year growth for grocery, superstores, discount and dollar stores. Now, this slide can be a little bit misleading here too, because what we're seeing is some big growth in discount and dollar stores, but that is largely unit driven growth. These slides are encapsulate both new stores as well as any changes in visits per location, kind of your comparable visit. So this slide here is interesting because we do continue to see the, you know, kind of the rollover of all the store openings that we saw in the dollar and discount store, which started to slow in the back half of the year. But you still see big year-over-year gains. But what's interesting is we're starting to see that comparable visit for dollar discounts starting to be weaker, and in some cases negative for a few of the chains, which is exactly what the dollar stores have said. At the same time, superstores, we see the number down year over year, but on a comparable basis, that number is actually up. We've seen a little bit of optimization for Walmart in terms of the store footprint. And so on a year over year basis, the number of stores that are down. But if you look at a visit per location, particularly in the back half of the year, that number is actually up as we start to see some of the rollbacks, and they've started to capture some of the incremental customers in that 100,000 and above range. They talked about that a little bit this morning on their earnings call. So it's something we're seeing. And then grocery is another one that's just been so interesting just because we've seen so many different trends. We've seen the rise of kind of the value grocers, the Aldi's, the Lidl's, grocery outlets. We've seen kind of the conventional grocers, stagnate a bit, but now started to have their own price rollbacks and starting to get back in the game. I've talked about it before in the past, like retail or consumers are shopping a wider number of grocery stores than ever before. But what we're starting to see is that, after kind of a couple of years of figuring out where I can get the best deals to fill out my shopping basket, at the different grocery stores, that behavior is starting to normalize. I mean, maybe you're not, if you see something, a new deal, you might go there, but people have kind of figured out which brands, which grocery store brands they trust. And so maybe that idea of experimenting and trialing as many grocery stores as they were doing the last couple of years as you were dealing with inflation, that might be starting to wane a bit. So those are kind of the starting point. Deborah, any thoughts or reactions on this front?
Yeah.
Because it's been a lot going on here.
Yeah, I mean, I think what's really interesting if you start to just look at the data, right? The number of store openings like a Sprouts, right, is and they're just I think it's like the smile, right? They've just got part of the country. And so I think, from an investment standpoint, you start to look at where's the growth opportunities. And they don't tend to, right? They're a perfect complement to almost anybody because they carry an incredibly unique line of, range of products. And then if we look at like the ethnic grocers as well, so I think there's still a lot of excitement actually in the space. It's just in maybe less traditional.
I think you're right. And ethnic grocers has been a really interesting area to look at. That has been a hot space, not just in terms of new unit openings, but if you look at the visits per location, um, they're going up. The trade area sizes are getting much wider. So you're capturing an audience, not just, kind of, beyond who you would think would be going into those locations. You're capturing a much wider audience on that. And to your point, organic, natural, and fresh food is kind of having another moment here too. And I think what's really smart about it too is Sprouts has really shrunk the size of their stores, really focusing in on bringing merchandise that targets that high lifetime value customer and doing an exceptional job at that. And I think you're going to start to see a little bit more of that lead. I think we're starting to see a bit of it in that space too. Maybe you don't need that same box size, but maybe a smaller format can get into and really hyper focus, and laser in on that target audience that you're looking for. So I think we're going to continue to see that. We've got yeah, sneak preview. That'll be one of my predictions if we get to 25 is continued evolution of store formats. But I think that's a big part of what's driving it.
Yeah, I agree with you. And I think that, as we look ahead to the next slide and start to think about this balance between staples and discretionary, as some of the grocers are also carrying more discretionary merchandise, you
Yep.
talk about, right, people get used to kind of going to a store for a certain product, but now they can actually buy a fuller range. And then I think when
Yep.
it comes to ethnic grocers, right, goes back to you don't know what they're going to have every week, right? It like kind of mixes it up. And I think adds some excitement not only to your shopping visits and shopping frequency, but also to kind of the range of products.
That's a big part of it too. And I think that's, if nothing else, one of the key messages that we learned in 2024 is, value is important, but it's not enough. If everybody could just win on low prices, then everybody would be a winner. There is that element of merchandising and excitement that really needs to be part of the overall mix. And I think that we're going to see a bigger shift towards that. I mean, I think we've already kind of hinted at a little bit of that, consumers, frankly, maybe a little bit bored and looking for new product innovation. So if you can combine some sort of value messaging with newness, that is the recipe to win. And that's a perfect segue into kind of the warehouse club segment, because I think they're doing a really interesting job on that front. They've always been known, obviously, Costco for being exceptional merchandising teams, with that low SKU count, high velocity type product mix. They've done an exceptional job. And what it's even more important, because they're starting to capture a lot more of that Gen Z. You talked about at the onset about that group being more discretionary spending power. Well, Costco's done a really good job matching that. They've brought in some newer brands that maybe, particularly on kind of the household and personal care, maybe on the food side. They're doing a great job on that front. So I think that that's kind of interesting and kind of seeing where they're capturing market share from because you see these big numbers from the warehouse clubs, and that is really visits per location and visit frequency driving that growth.
Yeah, I think also at Costco, one of the big changes is, really leaning into technology, performance marketing, right? I mean, it's everything that they've always, right? I mean, I'm sure we all remember, right? I have dogs and I get, kind of promotions for cats, right? But these days it's only dogs. And so that kind of taking an incredibly well-run kind of store, company, et cetera, and then layering onto it, let's call it 2025 kinds of technology. And they didn't, some ways they didn't have tech debt because
Yeah.
they hadn't invested in it. So it's fascinating because it's not what people would expect.
No, I think you're right. I think that they don't get enough credit for some of the technology investments that they've made. I think that's a big part of the success they've had in the recent call it 12 to 18 months here. I think that's a big part of it, and I think that they deserve a lot of credit. And I think Sam's Club's another one too that deserves a lot of it. We've seen, particularly in kind of the Western markets, that's where they've really started to pick up some of that younger audience, and particularly maybe in the California market, we've seen Sam's Clubs really doing well on a year-over-year basis, and I think some of that taking some of the learnings that Walmart has had and applying it there as well. So it's fascinating to look at, and should be another big 25 for the club space.
And before we move on, we've got three questions I just want to make sure we address. So from Lawrence, it's a great one actually. And it was just at FMI and it came up over and over. How have weight loss drugs impacted restaurants?
It's a great question, and actually, that's a perfect segue to this, Deborah. If there's another question, I want to say that just because it does tie into the discretionary retail slide. I promise I'll make it work, but I say that for this slide. Are there other questions we want to get to
Yeah,
before?
and actually they apply to prior side. So can you clarify how you define superstores versus discount stores?
Sure. So superstores would largely be your mass merchants, your Target, your Walmart. I think we do include the clubs as part of that grouping. Discount and dollar is largely going to be your dollar stores as well as your liquidators, like an Ollie's or Big Lots in there. No, not Big Lots. Ollie's, Big Lots, I think is kind of in superstores, but the liquidators would be part of that. So that's the quick definition. It's again, everybody's got slightly different definitions on it, but that's how we'd characterize it.
Perfect. And then how is the role of this is from Monica, how is the role of the store changing? The high streets are empty, some are expanding. Is it still good to expand your network of stores or should we wait? What would be a way to be more efficient in our store operations?
So in terms of store growth, I mean, we've definitely seen the algorithm change in terms of how really all brands across any category are changing. I mean, and a lot of that's because of migration. A lot of that's because it changes consumer behavior. We've seen people move away from urban to more suburban and rural. We've seen people move away from markets like New York, Chicago, San Francisco, Los Angeles into Phoenix, Texas, Central Florida, the Carolinas. And really the interesting thing is not uniform in terms of the household income. We've seen household income migrate to more of the Carolinas, Central Florida. We've seen, actually an increase in lower income individuals moving into the Texas markets. Phoenix is kind of neutral. But because all this is really changing, the way brands are going about it, maybe high street is not the answer. Maybe you want to look to something more suburban, more college town, which is where we've seen a lot of growth as well. So that's something that, is interesting. And again, we talk about a place where we can look at visitation trends for any physical location. Well, that does include cities. So we can look at migration patterns and what may be changing there. Because if you're using census 2020 or earlier data, it's really outdated at this point. So I think that's something that we're going to continue to see evolution. We'll talk about some of this too at the later part of the presentation. But getting to the question about GLP-1s, because I think that's interesting. There was a lot of noise and a lot of chatter about that last year in terms of what impact we see. And we saw the numbers of the pharmacy when the grocers that do have pharmacy departments start to report things. It was a driver. But what's interesting, so if you see two categories that stand out, particularly in the back half of the year when we get to discretionary retail, we see two stand out, and that's apparel and home furnishing. And as we got to think about it, why those two categories? Home furnishing, that's a bit of maybe there's a replenishment cycle going on. We're about 5 years after the pandemic. But then we got thinking, is there more to it? As we started talking to some of the management teams that are customers of ours in this category, some of them said, we're seeing a real driver from GLP-1s is, people worked on their, reimagining their body, health and wellness. And so they wanted to show it off this holiday season. And that was a big driver of apparel sales. And then the derivative of that is like maybe you're going to host a party at your house and you maybe want to refresh things. So what we're kind of dubbing this is kind of a year of reinvention right now. It's kind of apparel and home furnishing are two categories that continue to do well even into 25 as people kind of there seems to be a ripple effect, not just GLP-1s. I don't want to say it's just that, but kind of a bigger focus on health and wellness. And so that's kind of driving that. What that may do is that we have not seen, I'd say, pressure on restaurants yet, but it may be coming. We might start to see a little bit more pressure on the QSRs, which actually, it's interesting, the QSR sector is actually underperforming the full service space, at least in the back half of 24. And so we might start to see a little bit more of an impact as consumers are kind of focused on not only losing weight but keeping that weight off. It's counterintuitive, but fitness is another category that was exceptionally strong towards the end of the year. Normally, you see that end of year lull when people are waiting for that New Year's resolution, but that held up relatively well. And that may be questions like, well, if people have already lost weight, why would they go into gyms? Well, they want to continue to embrace that healthy lifestyle. So I think that's kind of interesting place. So kind of ties everything together into one bow here. I know that was kind of a one step to another and jump to conclusions type answer. But Deborah, any thoughts you have on that as well?
Yeah, I mean, we're seeing with GLP-1, right? Not only, I mean, you go to the stores these days, right? And you're seeing out of stocks in products that have, right, a lot of protein, right? Because that's
Yep.
kind of what the doctor ordered. And I think also in the same vein, the kind of protocol is to spend more time at the gym, right? Strengthen your bones, et cetera. So we're absolutely seeing consumers lean into that. It has been interesting, kind of housewares versus furniture and just some of the divergences in those two categories, which I'll look to hear more about. But lastly, I think when it comes to, full service, I think it goes back to experience,
Yep, it
right?
does.
So going back to tying it up with a bow, right?
Yeah,
Th-
exactly.
This idea that the consumers really want to kind of lean back into that experience economy. And I do think that that really starts almost in full service.
It does. It does. And it's interesting because we're seeing a lot of the mall owner operators that we work with. There is that experience feel. There's almost a bigger push for kind of local and I'd say regional brands as well on the full service side. And again, just different experience than people may be used to. Now, I mean, there's still demand for an Olive Garden, for Longhorn Steakhouse, and some of the stalwarts in the category. But we're hearing from a lot of mall owner operators that they want something new to kind of generate that buzz and that excitement and kind of that experience-led economy. I think you're exactly right. So, part of many changes that we're seeing at the mall, and some of that we'll cover as well.
We do have a question from Richard. Can you comment on the decline in the visits to beauty stores?
Yeah, it's a great one too, because we did see that kind of taper off, the back half or most of 24 actually as well. I think on that one, it really is a case where maybe there's too much supply in the market. We saw a ton of store growth. I mean, if you go back to 22 and 23, the beauty category was the number one category in terms of year-over-year visit gains both years. So I think if you're talking about two really big years in terms of both not only store openings, but also visits per location growth, I think we're getting into a case where maybe we're a little bit, there's a bit of supply demand imbalance in the category right now. And so I think we're starting to see a bit of pullback because of that. Just that there's a lot of locations out there. We are starting to see too. I mean, we look at our cross visitation data, and obviously, I think that the Ulta partnership at Target, the Sephora partnership at Kohl's, I think that at the early part. That was incremental to drive visits. We saw that maybe the visitor got introduced to that brand when they go into a Kohl's or a Target, and then continue to go to that brand. But now it's starting to kind of, I think, with all that unit growth that's kind of baked in, maybe we're starting to see kind of the tipping point on that category. Now, I do think we did see, beauty have actually a nice holiday season. December beauty growth was okay, so I think that plays into kind of that year in reinvention part. But I do think we're at a case where maybe, the growth that we've seen the last couple of years, just we're kind of lapping that and kind of running into a bit of a headwind on that front.
Yeah, I think, it goes back to kind of health and wellness, which we're seeing as a topic across all of retail and restaurants. And so this idea, I think, as well that like, skin is your largest organ. And right, there's just I've seen a lot more kind of written about this, focus on it, and you're really starting to see kind of health and wellness across categories. That's that's what I also think is interesting. All right, we've got two more questions. So from McKenna, what markets do you see, kind of surpassing beauty? Where do you see beauty maybe is kind of fully entrenched, and where do you see opportunities for growth?
Yeah, in terms of markets where it's fully entrenched, I mean, I think, yeah, retailers are smart. They follow where the population is growing. I think we're seeing some of the southern markets that I mentioned, where there's been a lot of growth. I think that maybe they've, probably reaching, kind of the point of, where they need to be in terms of maxing out in terms of the number of locations. But what's really interesting is kind of, I do think there's still opportunity in kind of these secondary markets. And I know Ulta is chasing some of these secondary and tertiary markets. And by that, I mean kind of markets under 200,000 in population, maybe even under 100,000, because with the population movement and the changes in household income and the persona moving into those markets, it's been a bit more viable in some of those markets. And we've seen some success stories in that. So, yeah, it's hard to put, kind of these are the markets to go after. I mean, each brand is a little different. You need to really be aware of, where your target customers are and where the opportunities lie for those. But we are seeing with population movement that there's some secondary markets that are really attractive, particularly in kind of the I'd say the southern and southeast and southwest markets.
This is from Liz. Would love to hear more about the experience economy. Is this showing up in travel, wellness programs, or other cultural experiences? Not sure it's in the data, but curious if there are anecdotal insights.
Yeah, why don't we save that one for the next slide because we are going to talk a little bit about the experience economy. So we will get back to that one. But I did want to spend a little bit of time just on the luxury space because this has been a little bit like the beauty space where it's had a pretty good run in 22 and 23. 24 was a slower year on the luxury side. Not a surprise there too. Consumers, being more discretionary with their budgets, things like that. But one of the things we did see is a little bit of momentum as we got into the holiday and into 25, we're, back to at least a little bit of positive growth here. And when we parse out the data here, we're starting to see kind of that bridge luxury. So it's kind of the next, maybe not your premium luxury, your ultra premium luxury brands, but some of those brands that are kind of a step up, and particularly kind of the newer brands. Maybe so it was a D2C brand that's now starting to open up locations. That is where we're starting to get a little bit of momentum and kind of this idea of newness and kind of new brands bringing to the table. I think that is starting to see what we're starting to see in this luxury category as being a key driver of growth as we enter the year.
I think you also had some of the brands, not to be mentioned, where you had seen overproduction.
Yep,
And so that I think worked its way through 24 as well. And so the sector has definitely had its kind of not only haves and have nots, but some of these companies have managed either, supply chain much better or just thinking about kind of availability of product and in what markets. So I
100%.
I
Yep,
think,
100%.
and we're seeing as we look at 25, some of these companies really going back to really lean into, which we wouldn't have said in the past, right? Demand forecasting, inventory allocation, pricing and promotions. And so very kind of 1, 2, 3, 4 as it relates to supply chain. And that I think is also starting to help drive better numbers.
Agree completely. So I promised we would get back to the experience economy here. And so one of it's coming up here. We've got a slide on that in a minute. But this is kind of, it ties into this slide as well. So malls, it was interesting. One of the big takeaways from the holiday season to me, above everything else, was that we saw more visits to malls than retailers. People were going to malls in greater numbers and not shopping. They were going there for maybe it was a holiday event, maybe it was some sort of promotion, maybe it was taking pictures of Santa. We saw, and it wasn't just by a little bit. We saw it was pretty meaningful. Admittedly, there were some movies that period as well. Moana 2 helped out things as well. But if you look at not only the year-over-year visits to the mall, but also the dwell time, it seemed like there was something happening. There's a trend starting to take place or start to kind of really emerge through. And I really do think this role of mall has really changed from just being a shopping destination to being an experience destination in a lot of cases. So kind of tying back to this idea of experience-driven economy, people are using malls in different ways than they ever have before, and a lot of that is a byproduct, a function of what we've seen the last couple of years as malls have started to invest in more mixed use. opening up things or allowing spaces for concerts. And a lot of times marketing the mall as a brand itself. This mall is good because they have these kind of events and kind of, being, one that distinguishes themselves for that. And so we see some of that in the data. We see, generally speaking, that mall visits continue to be positive. Now, admittedly, there's some things going on in the numbers here. I mean, January was 24 was weather last year. April 24 was a weird calendar month. September as well. December was a little bit of a weird calendar with a shorter visitation period. January 25 overlapping weather again. But if we look kind of by and large, particularly A malls, and we're starting to see this a little bit in the B malls too, overall positive visitation trends above what we're seeing at the retailers. And so I think this ties back nicely to this idea that consumers are looking for experiences and looking for other ways to embrace and interact with that mall. And so a lot of mall owner operators are getting very good at thinking outside the box here in terms of how else can we engage with consumers right now.
So I'm glad you opened the door. I didn't know if I was going to have the opportunity to talk about this, but we've talked to several of the REITs that actually, in the past they've typically, Santa's been kind of a loss leader, if you will.
Yeah.
And they've approached Santa differently. So there's actually companies that can do your Santas across your fleet. And they've actually, instead of it being a negative, they've actually seen it be a significant positive in terms of revenue drivers. So
Yeah.
it goes back to, right, this industry, which, kind of has been around since the kind of day of the dawn, right? But we're starting to see real, I mean, I look at that as innovation and how they're things, and they're really leaning into fixing some of their pain points. And I think you know, that's been different than what we'd have expected. Before we move on, we got a question from Rich. You may be about to answer this, but in beauty, where's their traction?
Yeah, like I said, it's some of the newer brands. I mean, I think we see it in kind of a couple places. Some of the direct-to-consumer brands that are starting to either have a physical presence or starting to expand their portfolio. This is another one though where we've also seen kind of brands that target a more diverse audience, if you will, also stand out. Ulta's done a really good job on that front, diversifying their assortment there. That's really helped to change their visitor mix. Looking at the trade areas they're coming from, it suggests that we're seeing higher visitation from both Asian and African Americans consumers. I think that's where some of the growth is still kind of in more, quote unquote targeted. Let's kind of get a little bit more, or targeted, certain groups, or target certain attributes too. I think that's been another thing that we start to see is that certain brands that really, this is what we're solving for you. This is the feature that makes you that's special about our brand. So kind of that hyper focus on either utilization or different, ethnic groups, I think has really been a powerful driver in this category.
All right, so from Craig, outside of malls, which other shopping center types, neighborhood, community, etc., are experiencing visit growth?
Strip centers are definitely one of the bigger categories. We didn't have a chance to break it out into this particular slide, but they're generally in that mid to high single digit range in terms of year-over-year growth on average for the last year. There's been a lot of changes, and I think partially because of consumer behavior and where they're doing more of their day-to-day shopping, that's been a big part of it. But also some of the changes being made there. So I think that's been a big driver. That's been a big one too. That's one that really stands out above all here.
And then Carol asked, you are only tracking what's purchased in a store versus directly from the supplier or third party. Is that correct?
So our data is just visitation data. All we are tracking is how many people have gone into the stores. Obviously, there is a pretty good correlation to transaction, but that's going to depend on the category too. So for the more discretionary categories, a visit may not always end up with a 100% conversion. For grocery and kind of the staples categories, the conversion rate's much higher. But we are just tracking visits to those stores. But that also is a pretty good proxy for both transaction growth and other things as well.
Perfect. All right, what's next?
Yeah, so let's keep going here. And we talked a little bit about apparel, but this is one where we're seeing again this movement. We saw a big increase in apparel retail year over year, but it's also shifting the landscape a bit too. And so what we're showing here too is off-price apparel. So that's going to be your TJ Maxx, you're going to Marshalls, your Burlington. Thrift stores has also been a big category to keep an eye on. I've seen a lot of growth in that category as well. And what's interesting is that really is not a ton of unit growth in that category. That is largely visits per location and visit frequency driven driving that. We did a project for a thrift store chain just this week, and they confirmed that they're seeing a big change in the number of visitors. Now, non-off-price apparel as a percentage of the overall mix has declined. That is largely going to be some of your store closures that we've seen, particularly the department store category. But it's interesting to kind of see this evolution. I think the takeaway here too is, thrift stores historically, you don't see, high income consumers, but that's where that growth is coming from. Actually, that visit frequency, that incremental visitor is going to be your 100,000 household and above. And so, this idea of kind of wanting a new wardrobe and standing out, well, may have ways to kind of accentuate that with kind of a thrift store visit as well. Kind of plays into this kind of treasure hunt atmosphere too. People are looking for excitement and newness. Maybe you can find something you never expected at thrift stores. We've seen that obviously off price, I think, has been a big driver of that. Some of the liquidators, we've seen success with that as well. But I think that's also helping to drive thrift store and kind of tying things back to some of the themes we've talked about today. That's kind of what's, I think, the story behind this slide.
Yeah, I mean, I think that what we've seen in our focus group work is that consumers, especially Gen Z, that if you think about it, and it was like the minute somebody said it, you're like, aha, that there's only one of, right? So at a thrift store, there's only one of this.
Yep.
So it is truly that kind of unique. And I think going back to, if we can tie it back to luxury, right? When you had, overproduction, right?
Yep.
And there was, mass quantities of the same exact product, which is really, if you think about it, there's always been more of a scarcity kind of
Yep.
feel around
Exactly.
it. So ironically, what we've seen is that the consumers leaned into thrift because of the unique kind of idea around just the concept in general. And so I personally believe that we'll see that grow. And we're also seeing them take their real estate strategy much more seriously than they have in the past.
I think you're exactly right. It's we're getting a lot of inbound requests from that category about site selection. So I completely agree with you on that one.
All right. Mary Beth asked us, thrift stores are big Gen Z drivers. They want uniqueness, personalization. What do you think is next?
I mean, I think continued growth in that category. I mean, I think there's some brands in that category, Savers, Value Village, a few others on the apparel side too that are starting to be really interesting about not only, to your point, kind of professionalizing about site selection, but also how they get their merchandise. And so one of the interesting things, I mean, we, talk about ripple effects from GLP-1s and people wanting to renew their wardrobe. Well, that could potentially mean that there's a lot of, filled up closets too. So there may be an opportunity for, in terms of inventory, for a lot of these brands. So I think that we're going to continue to see a big 25 for a lot of the thrift stores, opportunity to get, a lot of inventory. And, to your point, that scarcity is driving a lot of demand right now. So I think, what's next? I think that they're going to continue to see very, very strong 25.
Perfect.
It's, odd to think in 25 that we have a slide on Barnes and Noble, but it kind of does tie into a lot of what we talked about. And, this idea of kind of experience economy and, what we've been talking about in a little bit, kind of one of the aspects of this is kind of a lack of third place, like a lack of place outside the office, a lack of place outside the home. We've been now dealing with some sort of hybrid work model or work from home for, 5 years now, and people are looking, to get out of their homes to maybe find other places to meet up with people. And Starbucks, I think, has been the issues they've seen the last call it 12 months, but probably even before that have been well documented. The idea that maybe they leaned in too much to the convenience aspect with mobile order and pay, maybe forgot about that traditional coffee house feel. Brian Nichols, the new CEO, I guess is not new anymore, has really talked about bringing that back, the coffee house feel. But I think what that did, with Starbucks being less of a third place, at least the last 6 months, that's opened up a spot for some of these new third place places like a Barnes and Noble. It's not the only one, but we're starting to see it from other places as well, kind of opening up an opportunity for some of these brands to reinvent themselves as a third place and kind of tap into this idea of an experience economy. So, it's kind of, this really ties in nicely with some of the themes we've talked about today.
Oh, so I'm gonna double click on the Starbucks, right? So they changed their loyalty program in February of 23,
Yep.
right? Took some time. I mean, I was like going back to sometimes it's as plain as the nose on your face, right?
Yeah.
And I mean, hey, I have to say, as somebody who had been a very loyal customer, I was like, you know, you started to see them, and you weren't even necessarily self-aware that you were changing your habits. And I
Yeah.
have to say, right, we spent more time at Barnes and Noble, right? And it just goes back to, and they're in close proximity as well. But I do think that don't mess with people's loyalty programs. And
Yeah.
on the flip side, right, I still think I have to say it was NRF. I was actually NRF 23. That was a huge topic of conversation.
Yeah.
And I expected to see some really interesting, also kind of like cross retailer. We still haven't, for any of you who are involved in tech companies around loyalty, I think that there's a huge opportunity in 25. And I think that, retailers are really interested in leaning into that as well. So it is one of the areas I think is really critical. And then on the Barnes and Noble side, right, we're seeing, they've kind of changed their entire, if you will, kind of store operations team and focus. I mean, this is an area they're really leaning into, and so I think they're not only thinking about kind of unique formats, unique spaces, but also what does that relationship with a customer look like, and how does that continue to evolve? Like, what do they have permission to sell? So I think it's a kind of juxtaposing those incredibly interesting, RJ.
No, I think you're right too, and I think the paper source acquisition for Barnes and Noble is a really interesting one because it opens up the door for a lot of new product merchandise. It opens up the idea that maybe you can do different format stores or multi-brand stores. Yeah, that's another one that's really interesting, and again, I love all the sound bites that I get from you on these calls. But don't mess with loyalty programs. That's a key message. We've learned a lot of cases with our visitation data that can be particularly for high frequency visit type concepts, that can be a major deterrent for visitation trends. There's other things going on, and I do think that they will eventually resolve a lot of it. The Starbucks brand usually does find a way to course correct, but it's been interesting to watch kind of the
Been
behavior now.
slow. It's been slow.
Yeah.
All right, we've got three questions that I think we need to answer. Well, on the slide for clothing, are people spending more in terms of dollars, or are they spending the same amount or less and buying more units because they are shopping more discounts?
I think it's more units. I think that's something we've seen. I think that's definitely a case with kind of that shift to more of the value-oriented space there. So I think that's definitely something we've seen. But I mean, the visitation trends, I mean, again, it's kind of across everything in apparel. It's something that we've kind of seen play out there.
This was a good one. How has this has always been kind of some of the, I think, questions around the Barnes and Noble model. So this is from Mark. How has Barnes and Noble sales mirrored the average visits?
Um, Good question. I don't know if I've seen exactly that. I do see the visitation trends, and again, they're usually a pretty good proxy for the sales numbers on that. So I suspect that again, we've seen a nice uptick on that as well. So that's my guess is that there's a pretty good correlation on that front, but I don't have the actual sales numbers in front of me.
Well, I think that while they kind of still encourage, lingering and whatnot, and many of their stores, their newer locations, they have made it, I think, more about kind of, you can browse and buy as opposed to just browse. And so I
Yeah.
think that they've really changed the focus. I think they've put in a lot more discretionary merchandise. I have to say, like, of a retailer to choose to talk about, it's really quite interesting how quickly they've changed,
Yeah,
and
I agree.
especially kind of where they've come from. All right,
Yeah.
so from Matthew, do we think these numbers are softer than actual trend due to some locations being temporarily closed for refreshes, at least in my neck of the woods?
Yeah, I mean that's a good question that we have seen that there might be that element of just kind of if you look at year over year numbers as well. But I mean, I think again, this is average visits per square foot. This is the share of visits that are at least 45 minutes. So I think that still holds here. I mean, if you're seeing that many visits per square foot, that's gonna be post remodel in a lot of cases too, and we do definitely see a lift in visits per square foot when we look at that. So I think that's going to be picked up. I mean, the remodeling aspect is something that should not be understated for this brand as well.
Absolutely.
So Ashley's another brand that we kind of talked about home furnishing, and this would be a good point to come back to that idea of different categories doing different things in the space. We talked about housewares and kind of refreshing that. That you look and feel of your home, but value furniture is really held up pretty well as well on kind of two fronts. One is kind of, we talked about, Gen Z and more discretionary spending power, household formation, buying a home for the first time. I think that's been important for this group. And if we look at the visitation data for Ashley and what markets are doing well, it's kind of the markets. It's actually interesting. It's some of the markets that we've seen population move away from, like in New York or Chicago, and now we're starting to see a little bit of backfill from that, Gen Z population, that maybe there's more affordable homes in those markets than maybe they had access to before. So it's kind of interesting kind of playing out. And we see this with mattress retailers as well. So it's kind of interesting, kind of the idea, not only, housewares doing well, but some of the value furniture and mattress companies are doing pretty well as people start to relocate, particularly that lower income starting out their journey type customers as well.
Are you finding on the furniture side, because it's definitely been volatile, that it is the more value-oriented retailers who are seizing or gaining market share?
Generally, we are. So we see it with certainly, Ashley would be one. I mean, I think we've seen it a little bit with IKEA. We've seen it with a few of the other brands out there. Value City is one that kind of jumps out. And then we also see it with the mattress guys as well. So I think that's really kind of where we've seen it. There are some of the higher end brands that are doing okay in this category as well. But generally speaking, the visitation has shifted more towards the value. But I suspect that we're going to see a little bit of replenishment cycles start to kick in a little bit for some of those higher end, maybe 5 years out, and maybe that couch you bought during the pandemic is starting to get a little faded and it's time to upgrade. So I think we might see a little bit of momentum on both sides of it this year.
Great, thanks.
So this is an interesting one too, and kind of talking about what happens to real estate. I mean, obviously store closures was one of the big stories last year in 24. Obviously, CoreSite does a great job promoting and talking about all the research you guys have done on that front. But what's really interesting is what happens to some of these retail spaces after a new brand comes in and takes over. So a brand like Burlington, which did take over a lot of the Bed Bath and Beyond locations that exited the market, and see some really interesting opportunity, or some really interesting not only growth but also see some changes in dwell time, see some changes in the percentage of different visitors and stuff like that. So I think that's going to continue to play out. What brands are kind of looking to widen their audience to kind of get in front of get into new markets, get into other things when you take over these locations. So I think that's another trend as we kind of look to 25 and beyond. What happens to these real estates that were, became available because of store closures? I think some brands are being pretty smart and aggressive about getting into it.
Well, it's also been interesting. I mean, I still remember that day in December where we heard about kind of Big Lots and Party City on the same day, and it really
Yeah.
caused everyone, myself included, to think differently. But that like demarcation line, then I think kind of what happened in terms of the sale as well, right? That also I think has been very interesting in terms of, the future of those units.
Yeah. Yeah, I think so too.
So I think that's, I mean, would you have, I mean, I have to say this was, most of the data, I'm like, okay, that makes sense. This is one that, certainly is different than one might think. So it goes back to, right, location, location, location.
Yeah. No, I think it is. I mean, I think if you look at the data here too, I mean, in a lot of cases, some of these brands just, and we talked about the idea of newness. Some of the brands that have exited the market, that was one of the flaws. I mean, now there was a lot more to it. I mean, might be just markets not matching the merchandise. But this is one that's interesting to me, just like, when you do see a Burlington come in and replace a Bed Bath and Beyond, in a lot of cases, the Bed Bath and Beyond stores we looked at, it seemed like they were all like, typically we see a pretty standard bell curve when we look at kind of visitation trends at a chain level. You've got your underperformers, you've got your high performing locations. We start to see kind of when we start to see a skewing to kind of the decrease across the board, then that usually suggests some sort of inventory or merchandising issue, and we start to see that. And so you replace Burlington, which again is kind of this idea where scarcity, uniqueness, replacing kind of the standard merchandise. It is interesting to kind of see the impact of that.
Yeah, I mean, as you look ahead, is there anything that you're starting to see under the surface from a trend perspective that you wouldn't have expected so far?
Yeah, I mean, and it's a good segue to kind of talk about a couple things here too. I mean, we did talk about the year kind of, reinvention and kind of experience. And I mean, some of that I think people thought was going to be maybe more of a holiday thing. This is something that's going to be strictly confined to Black Friday, but the data seems to suggest early on that we're starting to see this continue into 25. People are looking for excitement, for uniqueness, for a story they can tell about a product they purchased. And I think that's going to continue to play out. I think this idea, physical retail is, more important than ever. I think continues to hold true, and I think we continue to see that. I mean, there's a lot of signs that even though physical retail is certainly continuing to evolve, it's more important than ever. Not only from a brand messaging standpoint, from a retail media standpoint, from just really kind of a kind of holistic approach to omni-channel. It really is more important than ever, and so. A lot of the trends that we've talked about in the past, I think, continue to hold true here in 25.
So I will say I feel like it kicked off at your December conference, but at Discover, but we have started to see a huge uptick in interest in live streaming and a
Yep.
lot of that being done in physical, right? So I think that's the big difference between other geographies and the US, right? Is this idea of kind of physical first, but it goes back to it's an experience, right? If you go to a mall and there's, let's say there's 8 or 12 hours of live streaming, whether it's kind of at the, there's a built stage and all of that, right? So it's kind of more of an attraction, or even if it's in stores, that is, I will say that's one of the biggest changes we're seeing. And,
Yep.
it's about time. So,
It's amazing after you did talk about that at our panel Discover. It was amazing to see the response from the retailers in the room who wanted to start to explore and investigate that a bit more too. So we're seeing it on our end too. The amount of people who are thinking about in-store events and other things, live streaming maybe. That's another one that we didn't even really talk about on Ashley, but that's another part of the strategy that they've done is events to kind of get people excited and other things like that. I think you're right. I think that's gonna be a big part of the trend as we head into the next few years. I don't think that's just a 1 year trend. I think that's gonna be a certainly probably many years ahead on that front, because I do think that does tie nicely into the consumer behavior of a Gen Z customer who's coming into more discretionary spending power.
well, and one of the things that you brought up earlier was around, kind of this idea that, kind of placemaking. And
Yep.
I think that that is something, once again, we've talked about for many years, but to start to see that happen
Yeah.
uh, in many new ways, and whether it's concerts or whatnot. And then the other trend that we're really seeing, and it's like we've seen kind of smattering of it through the years, but I feel like a lot of the mall REITs are really leaning in is using kind of that out parcels.
Yeah.
So right, and so you now can see right, more of the experience, more of the change, kind of what's happening. And I think that when you're physically starting to see some of these things change as a consumer, you want to stop by and
Yeah.
see what it is that's happening. So I feel like from a physical perspective that things are changing more rapidly, and that there there is more interest in innovation from, and especially around, loyalty as well from the mall rates. And that I think is really quite interesting. And I'm not I mean, I don't know if you have like, why now, right? I mean, it's
Yeah.
really interesting.
I mean, I think some of it's just because we are starting to see more visitors in, and that's probably what they're directly telling these brands. I mean, the malls that we talk to are doing a much better job of, having that one-to-one dialogue with their visitors at this point. And some of that's being driven by, hey, this would be a good idea, or maybe they, hey, that out parcel maybe be great if you could put in an EV charger or things like that. So that's something I think we continue to see is just, kind of spreading around. It's a good segue too, and I want to just kind of talk about a few other trends before we wrap up today that we're kind of seeing in 25 and predictions for it. We talked about the idea of kind of innovation. I think that's another one of those key words for 2025. I would say 24 was definitely a year where there was a lot of focus on value and deals, and that's not going to change. I mean, that's going to continue, and that's going to be an important part of the purchase decision for any consumer. But it's the idea that you got to pair it with something interesting too. You can't just do low prices. I mean, as you mentioned, we do look at a lot of restaurant chains. 2024 was summer value wars in the QSR sector, but there were only a handful of winners. And so the idea that, those chains that kind of combine innovation with value is really kind of key in this. And so that's kind of what we're thinking here too. And we've talked a little bit about with dollar and discount stores and the visit per location numbers being down a little bit for those guys. It's got to be more than just kind of low prices. It's got to be, the idea that you're driving in and really focusing on innovation to drive visits right now.
All right, we've got two great questions. I've actually heard a lot about this. How have leisure sports, and sports venues performed? I'm not sure if we're just talking pickleball or more than that, but I'll let you lean in there.
No, no, no. It's a great question, and we have seen that those kind of sports. I mean, pickleball, paddleball has obviously been the one that's gotten the most notoriety, but there's also pretty much all sorts of different ones too. I mean, we've seen soccer fields at certain malls. We've seen and not even sports related, but we've seen more dog related or animal related venues and stuff like that. They've been a major driver, and if you look at kind of where people go to in the mall first with their visitation data. That has been kind of, one of those key tenants that has really driven a lot of things. We're starting to see so much growth in those categories. We are going to reach a tipping point at some point. But the nice thing about pickle and paddle is that they are use. There are so many different things that you can use those courts for. You can close up the courts and use them for events. So there's a lot of different purposes for those as well. So I think we're seeing a lot of success with those different sports are out there. Again, it's got to be smart. You got to think about the asset utilization within kind of a court like that, making sure that it's not just one thing, kind of lock yourself into one use. If you can use it for multiple purposes, I think we've seen some real success in those.
Yeah, and that leans into a question from Mark. Do you have any data for the drugstore industry? The front store of drugstores has almost evaporated. Office supplies has gone to Staples, Office Depot, Amazon, cosmetics to Ulta Beauty, Bluemercury, Sephora, greeting cards to texting and social media, magazines and paper. This is great.
It's a
Thanks,
good,
Mark.
I love the
It's
question.
great.
Yeah.
Magazines and paperback books to Amazon, receiving online and film, industry went digital. But I think that I really like the question on the drugstore industry in particular, because if you think about, I love our next call, we should do this like whole timeline because, if you go back in time, right, it used to be, this idea kind of how you shopped a super center is kind of how you shop the mall, right? You could do everything in one location.
Yeah.
And then I know that, I mean, I remember talking to many mall REITs, right? People weren't happy with grocery and grocery left, grocery's coming back, right? Because that's reversion to the mean, that's how it works. But in drugstores, I've been surprised, especially with this focus on health and wellness and kind of clinics, that we saw drugstores leave the malls, and I would have expected them to come back right at some point, but we still haven't. And I'm talking enclosed, right? We
Yeah,
still haven't
I know exactly.
at the pace that I would have thought. And this, if you can answer this, right, like I can sleep well tonight.
It's a great question, and I think we're both surprised at that too. I would have expected a lot of the national brands to kind of start to re-engage with indoor and outdoor mall to some
Yeah.
extent. We've seen it more at the regional level. I think some of the regional pharmacy chains have leaned into this a little bit faster than some of the national chains, and some of them have seen some great success. In terms of the question where we're seeing that visitation, from pharmacy go, it is interesting when we start to see a store closed. Say a market's got three drugstores of the same brand and one closes. And even though if they transfer the prescription scripts to another one of the stores in that chain, we actually start to see them go to grocery. We see them go to warehouse club. So that's part of what's driven that warehouse club growth. We don't see it with our data, but we suspect that some of that's going online as well. This is clearly a category that Amazon has its sights set on.
Oh, and
Uh,
cost plus with Mark Cuban. I mean, I think that, we're starting to really look at pricing in a different way.
yep, I
And
think you're right.
I think also too their opportunity going back to I think they have great loyalty programs, but I think that in a day and age where consumers are looking for more, I mean, it goes back like what's kind of crazy when you think about it, and I've actually thought about this a lot. We're really leaning in as a nation to health and wellness. Maybe GLP-1 is what sparked it, and people feel like they have more control. But the drugstores have been like net losers. And
Yeah.
so, I mean, this is something that is like perplexed me. So I've actually spent a lot more time thinking about it than we have the next 5 minutes to like dive into. But wouldn't you think that, right, we as a nation are more focused on health and wellness than we ever have been? We're spending much more money on it. Yet those retailers that we think of for health and wellness are net losers right now. And it just, I don't know, it goes back to, right, like if we think about like Costco juxtaposed to drugstores, right, where they kind of didn't have the tech debt and they like really jumped in, whereas the drugstores through HIPAA compliance and all this, right, they have had to spend, and
Yep.
now they're kind of, you know, I think it's more than knee deep, maybe it's thigh or waist, and and they just kind of can't lift themselves out. I mean, the fact that the entire industry, I mean, I have to say those earnings, I'm always like, oh no, do I really have to listen to this? Because
I think we a lot of us are in that same boat. Yeah, I agree with
yeah,
you.
because it seems like there's so much opportunity. So I hope that at least on one of our calls in 25, we start to see kind of like this spark, this ember in terms of,
I
you
think
know,
there's still a lot of work that needs to happen before we see that
yeah.
ember. And I think a lot of it, we've talked so much about experience and kind of that experience economy. I think that's the part that's missing there too. It is, front of the store, there's not much in terms of product innovation. On the pharmacy side, there can be challenges, in terms of, and I know they've, introduced some new technology providers, on that front as well, both of those chains, both of the major chains. But I think that's the part that's missing here is that people have to have a reason, like they wanted that experience to be enjoyable, and frankly, it just hasn't been as of late. So I think that's kind of the missing piece, and that doesn't happen overnight. But we've seen some brands that have started to make some changes. We've highlighted a couple of them today. It can be done. So
Oh, absolutely. And the other thing I think that's really interesting is like this continued strength. Once again, this sector, for whatever reason, we needed you to bigger dive into it because the math doesn't make any sense. Independence, right? You're not,
yeah,
you're seeing growth in independence, right?
yeah,
Because
exactly.
and I think goes back to, right, the consumer for the most part has sought healthcare information from those professionals. And when you're an independent, right, it's your business. It's that one-to-one relationship. So I feel
That
like
is a
there,
big part of it too, and I think that plays into that idea of experience, that one-to-one relationship. The drugstores right now not building that relationship. The independents and regionals, they're doing that. So
uh oh, Wendy,
we
I know we're almost out of time, but Wendy had a great point on the drugstore side, you know, kind of and or not viewed as health and wellness places. They're just viewed as places if I'm sick or I need milk or a candy bar.
exactly,
Such
and
a
that's
great
something
point.
that I think needs to change. So.
All right, take us home, RJ. Got
So
two
just two
minutes.
quick points here. Yeah, we talked about value, and everyone knows the innovation that Trader Joe's brings to the table. We've talked a little bit about the next slide here, in terms of new store retail formats, and I think that's going to continue to play out. I mean, this day and age, compared to just a couple of years ago in a higher interest rate environment and a higher labor costs and higher inputs environment, it's more expensive to operate a retail store. And I think because of that, to justify the ROI on a lot of these things, we're going to continue to see a lot of evolution in new store formats, smaller formats for some groups, larger formats for others. Kind of depends on markets and categories you're in, but I think that's going to be another major trend that see play out is continued changes in store formats, particularly as a lot of retailers have a couple of years of data to kind of all right be able to feel more comfortable about these decisions too. So I know we talked a little bit about store formats, but that is my last prediction for 25. I don't think I'm going too much out on a limb on that one, but if nothing else, I mean, I think the discussion we talked about, the idea that this is kind of a year of reinvention for consumers. This is a opportunity if you are really focused on experience and uniqueness and newness is really what is getting consumers excited. There are opportunities on that front, and maybe a chance to rethink your approach on not only merchandising but real estate and a number of factors. Innovation and newness can come in a lot of different forms, and so if that's what consumers are looking for, I think that needs to be a priority for any retailer, really anybody in the consumer sector at this point.
Do you know, I was trying to look up, which I'm not going to multitask, but do you know if these Hy-Vees have restaurants? Because that's
They do.
also
Yeah, the large formats do. They have kind of multiple kind of locations in there. Maybe it has a barbecue chain, maybe it's got a coffee shop. They typically have one or two, even three or four
do you know
restaurants.
the ones that you specifically pulled out here?
Yeah, yep, exactly. They
Both
do.
of them. Yeah, because I think that going back to kind of lessons is that the restaurants, what they've seen, right, is the attachment rate between a grocery visit and going to the restaurant. So, right, it's kind of ironic almost, right? You've just shopped
Yeah,
your groceries and then you sit down to have a meal at a restaurant. But that I think is, been really just counterintuitive and really sharp and is. maybe
It's
years
interesting to
to come.
watch too, because if you look at how the construction of a lot of new grocery stores are being set up, they're almost being set up with stalls for restaurants too. I mean, there's that food prep area, but they're almost being set up for individual stalls that, in theory, could convert into restaurants or delivery operations as well. So, yet another competitive threat. I mean, we didn't even get into it, and this we could spend a whole nother webinar on too. But the competition between restaurants and groceries has gotten a lot more interesting in the last 12 months, and I think that's only going to get more aggressive in the year ahead. So.
Yeah, I just want to leave this thought from Stacy, because for those who are not in Hy-Vee often, Hy-Vee is competing with Target superstores in the Midwest. They are making it an experience. And I think Hy-Vee is
Mhm.
always, I mean, probably one of the most cutting edge from a technology perspective, retailer. And, obviously have their own retail media network and everything, but, really, truly interesting. So, RJ, this was fun and dynamic.
Always.
We went to so many places I hadn't expected. So thanks for the time and
Exactly.
thanks to all of you. I mean, phenomenal questions. We really enjoyed this and we look forward to seeing all of you soon. Thanks again. And RJ, have a great rest of your day. Enjoy the
Thank
sun.
you. You too. Take care.
Bye.